Hello and welcome to the DiviX System presented by the Dividend Times. The DiviX System is a revolutionary approach to investing in dividend-paying securities. Why do I say revolutionary? I almost dismissed that claim immediately because it sounded too hyperbolic. But as I thought about it, not since DRIPs, Dividend Reinvestment Plans, has there been another unique approach to dividend investing introduced. The key difference between the DiviX system and most other books or programs is that they educate you on investing in dividend-paying securities. The DiviX system shows you how to invest your future dividends today for possibly even bigger returns. The DiviX system is dividend investing on steroids. I designed the DiviX system for my own use. It was going to be a simple way to pick up 2 to 4 extra shares of a 100 share lot purchase. For example, if I wanted to buy 100 shares of Apple, the DiviX system would cover 2 to 4 shares and I would pay the other 96 or 98 out of pocket. Putting my theory into practice, I was shocked at how many extra shares DiviX covered. 30, 40, 50 extra shares. In some extreme cases, it would cover not only the whole 100 share purchase, but had I chosen to use it, it would have also put spending money in my pocket. Cautionary note. Just because you can, though, doesn't mean you should. Once I realized how powerful this thing was, and I know this will probably sound cheesy, but I felt obligated to bring this thing to the world and wrote the Dividend Times, an introduction to the DiviX system. I almost didn't do it. Halfway through writing the book, I almost gave up. If you read some of the examples in the book, you'll notice that some of the purchase dates were months apart. That's because after several months, self-doubt and fear kicked in. I began thinking things like no one's going to buy it, it's going to get bad reviews, etc. Fortunately, I learned long ago in life that when fear and self-doubt kick in, that's when you know you have to keep going. Travel outside your comfort zone. That, coupled with the fact that also using the system with success myself, the sense of obligation returned, and I plugged away until the book was finished and I had it up on Amazon. Now mind you, it's not a literary masterpiece, but it does the job. In a minute, we're going to take a look at what DiviX has done, but first I want to address the low number of reviews and speak directly about the one written review. The reason the number of reviews is so low in number is because I haven't been advertising the book. I said I felt obligated to bring the system to the world. I didn't say I was trying to get rich selling it. I'm not comfortable with people investing their hard-earned money in my ideas that may cause loss, and I do not give financial advice for the same reason. The reason I'm talking about DiviX now is because of my other program, Closed-End Fund Mastery, has been pushing new attention to it on my site, and now that it is starting to build an audience, I believe people can benefit from my years of honed experience using the DiviX system. As for the written review to Warren in Canada, thank you so much for purchasing my book, and especially for leaving the review. I would like to address your points specifically. First, being process is more important. As stated in the introduction of the book, this is a no-nonsense book. I spent one chapter on the process because that is all it is needed. It's a very simple system. There are a lot of tips and tricks included, but the bulk of the book is charts, and they illustrate the many behaviors of DiviX when used differently. When you account for all of the variables, there are literally hundreds of ways to use the DiviX system, from very conservative to very aggressive, whatever your comfort level. You also mentioned that the company reviews become outdated too quickly. To this, I extend you an apology for not making it clear in the book that the longer you hold a successful investment, the better DiviX performs. And to illustrate this point, we're now going to look at the performances of the stocks written about in the book and look at how well they've performed since the book came out in 2015. When I wrote the Dividend Times, I wanted to avoid the appearance of cherry-picking stocks just to make my system look good. So the stocks I decided to write about was every dividend-paying security in the Dow at the time. I just mentioned a bit ago that DiviX can be used in hundreds of ways, from very conservative to very aggressive. The returns we're going to look at are the most conservative use of DiviX system written about in the book. I'm going to scroll through these returns only to explain certain points from notes I've made, but feel free to pause the video at any point to take a closer look at the other returns. Now the price quotes for all of these securities are as of March 20th of this year. Now, as you can see from the headers, we're going to be looking at the 5-year performances as written about in the book, and then here we are 9 years later with the total 14-year returns. If you look at the first stock, AXP, you can see that we have the returns listed for 2014, which is when the book came out, and then to this point in time, 2024, since the book came out. And then below that, you can see the difference of without Divi-X, which is basically just cash. You can see how well AXP did in the book and how well it's done so far compared to using Divi-X in the book to how it's done now, and then the differences between the two, also the total difference between the two, and then right here you have the annual percentage yield. This is the yield on cost from the initial investment. And as you can see, as of today, if you use just cash, your yield would be 9.74%, but using Divi-X, your yield would be 11.45%. A difference of 1.71%. Okay, so now that you know how we're going to read these, we're going to go through the returns and make mention of certain points as we go along. And since we're already at American Express, you can see that as written about in the book, that Divi-X has added an extra 12% on annual average in the first 5 years, as it was written about in the book. And as you can see now, that number is many times higher per annual average. Moving on to Boeing, you can pause if you want to look at the returns. You can see that the time frame only goes up to the year 2020. And the reason for that is because Boeing cut their distribution and therefore prompted a sell for Divi-X, because without a dividend, you can't pay back the margin. We're going to take a deeper look at Caterpillar later on in this video. Going on to Cisco. Cisco was a Dow component, but it did not pay a dividend when I was writing the book. They started paying the dividend shortly thereafter. So there's no returns listed for 2014 for Cisco, but when they did start to pay a dividend, which was only 1.38% at the time, those returns to date, Divi-X has added an extra 20+% to those returns with a slightly higher dividend yield. Now DuPont's a little strange. They had a 1-for-3 reverse stock split and dividend cuts, and I tried to get the most current information to date for DuPont, but I went to a few different sources and none of them had the same stock history information, so I gathered this information from Yahoo Finance. The other source I was trying to use was Seeking Alpha, but like I said, Yahoo and Alpha have two different sets of data, so I had to pick one or the other. So I went with Yahoo. But based on Yahoo's information, these returns are correct. And you can see DuPont's paying a 1.19% higher yield with Divi-X than without it. XOM, this is historically a stodgy performer, and I say that because their dividend growth is not that very impressive. A five-year history would have revealed this before you invested in this stock, and one of the features that you'll be able to do using Divi-X is to quickly get a 5-year history of how a dividend-paying security would perform using Divi-X, but that'll be for another video. Now here we have GE. You can see in the first 5 years, Divi-X outperformed cash by 32%. But since the book came out, GE has gone completely downhill. And this is actually the one and only loss for 8.9% that Divi-X has experienced since the book came out. You can see that the returns dropped 143% with just cash, but 188% with Divi-X. And when the dividend was cut, Divi-X wound up slightly underperforming on the yield. However, GE then went on to go ahead and cut the dividend again, which would have prompted a complete sell of the position. The reason you didn't sell it on the first cut is because the payment amount was still able to be made on margin. But after the second cut, there was no way. So the position had to be sold, and as you can see, cash only, you would have been up 3.4%, but you would have been down 8.9% using Divi-X. This is the only loser of the bunch. Now, ironically though, had you taken the new distribution rate after it had been cut twice from GE and then used that distribution amount to take a new position back into GE on January 2019, you can see the returns are cash only 226.57, but with DiviX 285.77 for a 59% plus advantage for DiviX. And DiviX is still trailing the yield, but over time with a couple dividend increases, this will eventually surpass your cash only position. Goldman Sachs. This is one of 3 positions written about in the book that did not surpass cash only. And you can see we missed it by -2%. But since then, you could see that DiviX has taken the lead by almost 19 percentage points, as well as having a higher dividend yield. And as you'll see later on in the video, DiviX over time almost always winds up surpassing yields in cash only positions. Home Depot, you can see the returns and the yields are very impressive. AT&T, they cut the dividend in April of 2022, but the dividend still covered the scheduled payment. And even with the dividend cut, DiviX still is outperforming on yield. And I don't know if you've been following AT&T for any period of time, but recently they have been going downhill quite considerably. But in either case, you can see that DiviX is still outpacing a just cash position. Intel, this is 2 of the 3 that underperformed a cash position by only 3%. And since then, and since the book came out, returns have been less than impressive, but nonetheless, DiviX has taken the lead. Also, Intel cut their dividend from 37 cents to 13 cents of May of 2023. The dividend still covers the payment, so we can elect to keep the position. Although, considering its past performance, you would probably maybe want to cut the position for something that has more promise. IBM, like Exxon, is a stodgy performer. It's not a great candidate. 5-year history reveals this. If you have any position and DiviX doesn't overcome a cash position impressively, then you're not holding a very good position. Like I said, I don't like to give financial advice, but I would give serious consideration to ditching this for something else. Microsoft, when the book came out, DiviX outperformed an all-cash position by only 5%. Microsoft for that 5-year period was a do-nothing stock with very stingy dividends. But as you can see, since the book came out, this thing has taken off like a rocket. And DiviX has taken a commanding 161% lead over a cash position and a 0.86% advantage in yield over the cash position. Pfizer, this is another stock that's been punished big time, but nonetheless, DiviX is still outperforming in return and yield. UTX, this position merged with Raytheon in the year 2020, so we only have returns up to 2020, and as you can see, not impressive, but still a win nonetheless, with a slight disadvantage in the yield. This one's pretty cool. This is Visa. You can see that DiviX has an 89% advantage over a cash position and a slight advantage in the yield. These yields are pretty impressive considering the fact that at the time the position was taken, the yield was only 0.56%. This 0.56% yield wound up giving us a leveraged position of only 7.17%. And that very small percentage resulted in some very reasonable gains. So this is an important point I want to make, is that even if the thought of using leverage or margin scares you, you don't have to go big to take advantage of the DiviX system. And lastly, there's Disney. That's been beaten up pretty bad recently. This was levered at 13.57%. It had a very small yield, and it was a semi-annual yield, I believe, at the time. They discontinued their distribution or dividend in 2019, and that would have resulted in a sell for DiviX because the margin couldn't be paid back. And that wound up giving us a 38.96% return advantage over your cash position. And at the time the distribution was cut, DiviX also had a yield advantage. Now, in summary, for the performance returns, 100 shares invested in each of these positions back in 2009 would have totaled $116,739 in both cases, all cash or with DiviX. But with DiviX, you would now have a 62.15% advantage over just all cash, and the $72,500 advantage. And then below that, you can see that cumulative dividends for all cash would have amounted to $83,074 compared to $87,796 for DiviX, and capital appreciation for cash position $325,966 compared to $393,970 for DiviX. What is the DiviX system? DiviX embodies these three investment tenets. Number one, have income producing assets pay for everything. Use future dividends to invest in more shares today. More shares today may allow you to capitalize on future share price appreciation. Additionally, may provide higher yields on cost, as I have already demonstrated. Number two, creative financing. You don't have to take an all or nothing approach to using leverage or margin. Doing all can take it all away, and doing nothing may not get you there. Be careful. Brokers are very generous on the amount of money they'll let you borrow against your securities. They will give you the rope to hang yourself. Just because it's there doesn't mean you have to use it. The DiviX system only lets you invest in what your investment can afford. 3. Control the terms. The money is made when you buy, not when you sell. Obviously, you'll want to buy low. You can also control the amount that's borrowed and when and how you pay it back. Now, just how risky is the DiviX system? Personally, I believe car payments and credit card payments are risky. Those are guaranteed leverage losses. But as for the DiviX system, the examples I have shown you have a 97% success rate since 2009. That's an increase of 4% of the 93% success rate when the book came out. Using the DiviX system is super easy. Once you set up your initial trade, you just let the results speak for themselves. Okay, here she is, the program that inspired the book, the Dividend Times. Check this out. When you see the Dividend Times, you probably assume that it is called the Dividend Times because it is a financial publication, which happenstance now is. But check this out. The DiviX system, Divi, short for dividend, and X, multiplication symbol representing times, the DiviX system. Multiply your returns by multiplying your dividends. So now the question remains, the dividend times what? And that is determined by several factors. For example, share price, dividend yield, your broker's interest rate on margin, how fast or slow you want to pay it back. Do you want cash out every month or quarter or not? The DiviX system answers all these questions for you. Now, I mentioned to you earlier that we were going to take a little deeper look into the results of Caterpillar. And we're going to do that while exploring some of the features that are available in the DiviX system. When you open up the DiviX system, it's going to take you automatically to the control panel. And on this control panel, it has a list of features that you can utilize. We're not going to go through all of them in this video, but the ones that I feel are most pertinent. If you look at the very top, you have the selection leverage projection start here. If you click on this macro right here, it will actually walk you through the entire process of setting up a DiviX trade. But we're not going to do that for the sake of time. We're just going to automatically cut to the leverage projection worksheet. Now, this may look a little intimidating, but it's really quite simple. If you look in the upper left, you can see these yellow shaded fields, which are fields that you make your entries, your personal preferences. What you're looking at right now is the actual setup of Caterpillar that was used in the book. And it's all just basic information. Ticker, stock price when you purchase date, the dividend amount, how many dividends per year, the number of shares, payment percent. It's currently set at 1.25%. You can raise it or lower it if you wish to. This determines the monthly payment amount that applies to your outstanding margin balance. Margin rate. This is the annual margin rate charged to you by your broker. Return rate. This is the annual rate of return that you wish to receive. This chart over here is already populated with old data from Caterpillar, but if you were to open up a blank workbook, this would show you what a 9% return rate would look like, and then it would also project the anticipated returns you would receive on top of your expected return rate using Divi-X. Now, before we get to the following three fields, I want to skip over here to the rule of 72. If you're not familiar with the rule of 72, the rule of 72 states that if you divide the dividend yield into the number 72, it will tell you how long it takes for you to double your money from that dividend. And since we're looking at Caterpillar, whose information is now history, it'll allow me to better illustrate what this does. If you look at the first line based on dividend, it states that it would be 14.42 years for you to double your money based on the current yield. And since we're already looking at past data, we already know for a fact in the second line it states that based on your estimated return rate that you hope to achieve of 9%, the yield would take 4.34% to double your money. But since we're looking at past data from Caterpillar, we already know for a fact that based on actual returns, Divi-X doubled your money in 0.59 years. Does that make sense? So you went from, based on the dividend amount, you went from doubling your money in 14.42 years based on the dividend amount to 4.34 years based on your estimated expected return rate to only 0.59% based on actual returns using Divi-X. And we're going to talk a little bit more about this in a little while. Now back to the three outstanding fields. You have multiplier start, multiplier step, and multiplier pick. Multiplier start begins the range in the table below that presents you 17 different scenarios from which to choose from. Multiplier step is the increment in between each different scenario. You can change this you can change everything in the yellow, but you can change this particular multiplier to just 1. You see it goes from 80 to 81, 82, 83. You can change it to 10, 80, 90, 100, 110. The default is 5. Now to answer the question, multiply the dividend by what? Based on several factors that we discussed. If you look at the selection we already have, a dividend multiplier of 80, based on a dividend yield of 4.99%, that would result in an investment out of pocket of $2,245 with a leveraged amount of $1,120 for a total share value of $33.65. Now check this out. This is wild. If you break your quarterly dividend into a monthly payment, that monthly total equals $14 a month. At a dividend multiplier of 80, your minimum payment would be $14. And of that $14, based on 7.75%, $677 would go to principal, $723 to margin. It would leave you a net dividend of cash of 0. If you maintained the payment percent of 1.25%, at the end of the year, you would have a net of 90 cents cash. At the end of 5 years, you would have a net of $10.21 of cash. That goes in your pocket after the loan payment's made. Now you don't have to choose the option where there's no net dividend cash left over after the payment's made. Let's say we go to a multiplier step of 50, and let's say we choose dividend multiplier of 60. You can see that the payment drops $350 down to $10.50 a month with a net dividend of cash of $350 a month. Okay, now we're going to go back to a multiplier pick of 80, and then I'm going to draw your attention over here. This is the first 5-year window, and since it's already populated with historical data, we have actual results here. After 5 years using a dividend multiplier pick of 80, we have final results of 361.38 for Divi-X, 251.95 without. But if we go back to using a multiplier of 50, you can see that the total return dropped to 309.56%. And without remains the same because it's not using leverage. Now you can see at a multiplier pick of 50, the number of shares leveraged is 20.8. Going back to a multiplier pick of 80, it increases to 33.28 share. But it's pretty cut and dry, right? You enter your basic info, tweak it till you see the projected results that look good to you, then place your buy. Now in the book and the performance results that we went over were based on a variable payment percent. And the reason I did that is because if you wanted to get cash from your distributions, because a lot of people rely on dividends for income, this would be the preferred option to use. However, someone like me that doesn't necessarily need the cash, go to leverage summary. We'll discuss this whole sheet some other time. But if you look up here, you have different payment options. You can choose payment percent. Payment percent will decrease in amount every time the outstanding balance on the margin decreases, just like a credit card. You have an interest-only option where your dividends will primarily pay the interest outstanding for the month, and anything left over rolls back to you. You can choose fixed payment. What this does is it sets the initial payment for the duration of the entire loan. So for example, like we just looked at Caterpillar, the initial payment from payment percent was $14. This option would keep that $14 payment fixed throughout the entire loan until it's paid off. This would pay it off quicker than this. And then you have all divs, which is basically payment percent for the initial payment of $14, but any dividend increases or cuts would add or subtract to the payment amount. This is my preference. It does result in higher returns, and it also results in higher yields quicker if there are dividend increases, maybe not so much if there are decreases. You also have a dividend option, reinvestment or no reinvestment. Now based on your buy preferences, what Divi-X will automatically do is set up your amortization schedule. And this will change based on the payment option that you opted for. You can pause the video, take a look at it in more detail if you wish. And then just a couple more things I'd like to show you so the video doesn't get too long. You have your return scenarios tab. I modified this chart just for the purposes of this video. I extended the chart time 20 years, which I will be doing in the immediate future. Normally when you open up a workbook, it only goes up to 6 years, as you see here. Getting back to our Caterpillar example, this is the performance history in dollars for the last 14 years using Divi-X. You can see down here, you have a black line, that's your break-even line. If you go below that, you're losing money. This is the rule of 72 right here. This is the point in which you double your money. Now, because I expanded this chart to 20 years, it's hard to tell in scale, but if you look all the way over here, you can see the green line, which is Divi-X, hit the double your money line before the purple line, which is all cash. And this is a 6-month time frame. So you would have doubled your money 6 months before all cash. And after the 5 years, with all cash, your returns would have been with dividends, not reinvested, of $7,901.20. And with Divi-X, $10,358.04. Here are your returns up to the point of COVID crash in 2020. They both got hit significantly, but Divi-X still gave you almost a $3,000 advantage. Now, here we are today, or as of March 20th. All cash, your returns on a $2,245 investment, your returns would be $27,033. And with Divi-X, it's $38,610. Now, I want you to notice that over time, the breadth between these two lines, Divi-X keeps pulling further and further and further apart. Can you imagine where these lines would be 10 years from now? This is the advantage that Divi-X gives you. As long as the stock's a winning position, this breadth will continue to increase. Here we are on a percentage return. As of today, or March 20th, your returns with Divi-X were 1,623% compared to 1,106% for all cash, and the actual share price increased 964%. So the difference between this and this is because of distributions, not reinvested, and the difference between this and this and this is because of dividends not reinvested, but also using the DiviX system. These upward slopes right here, anytime that hasn't passed yet, this will add your expected rate of return onto the returns already achieved. So these lines will always slope up. Next, I want to show you the 20-year yields chart. You see we have your all cash yields, DiviX yields, and projected DiviX yields. Now all this information right here has been filled in because time has passed up until, partially 2024. And as you can see, the DiviX yield started at 3.74% after subtracting for interest paid on your margin, and Caterpillar, I don't know if you can see it, but it's over 4%. So in the beginning you start off with a shortfall, but you can see every year, and then actually into 2013, DiviX yield surpassed the all cash yield. And whether or not dividends are increased, the DiviX yield will continue to climb whether or not the company increases their dividends. For example, here you have 2 years straight, there was no increase in the distribution. It was 9.15 and stayed 9.15. But for DiviX, it went from 11.30% to 11.47%. And see, as long as there's an outstanding margin balance, the yield increases every single month. However, if you use the all dividend selection to make your payments to the margin account, you will pay off the outstanding margin faster, and then your yield will plateau. So you'll get the maximum yield sooner if you pay the margin loan off sooner. And the yield will usually be significantly higher than your all cash position. And again, I'll be making videos in the future for more features, but just for the sake of time, I'm only showing you a few. Here we have the 5-year dividend growth of Caterpillar from year 1, year 2, year 3, year 4, year 5. I didn't expand this 20 years, I'm not going to. What you want to see here is what you already see here, is that the dividend growth rate is greater than the actual growth rate from just plain old distribution dividend increases from the company. This particular chart will come in extremely handy when you do the 5-year histories, because the annual growth rate of a dividend in the past 5 years is a very good indicator of the future 5 years. So if you do a 5-year history and you see the green line not making much of a move above the purple line, then the dividend's growth rate is a dud. You would probably want to keep fishing for a better candidate. Okay, that concludes our first look into the DiviX system. Before I wrap it up, I would like to make a couple announcements. First, coming soon, possibly the end of May 2024, I will be coming out with the DiviX System dashboard. The DiviX System dashboard eliminates the need to update share prices in individual workbooks by allowing you to import all of your future share purchases in one place and have your entire DiviX portfolio updated automatically with a graphical representation of key data about your DiviX performance. I'm not going into detail in this video because it's already long enough, so keep an eye out for another video on this specifically. When this comes out, it's going to have a price tag of $49.50. Additionally, I will be making improvements to the original DiviX System workbook. It will be modified to allow for importation into the DiviX dashboard, and it will include 2 separate workbooks, one for 5-year time frames and one for 20-year time frames. This will also be priced at $49.50. Unless you are a current owner of the DiviX System workbook, it will be free, but you will still have to buy the dashboard separately. And there will be discounts available to be determined should you already own DiviX and would like to subscribe to Closed-End Fund Mastery, and vice versa. One last thing, if you are on the fence about being a DiviX user, this might give you a little nudge. If you read my book, available on Amazon.com, the link is in the description. There is a bonus code in the book that will get you the DiviX System workbook for only $5. I will be ending this code on the last day of May 2024. I recommend buying the paperback just because the charts will be much easier to read. But if you are a subscriber to Kindle Unlimited, you can even read the book for free. And if you could, please leave a review. That would be very helpful. If you haven't yet, please like and subscribe. In addition to my closed-end fund videos I'll be posting, I'll be adding tips and tutorials for the DiviX system as well. If you have any questions, feel free to drop me an email at the Dividend Times, all one word, at outlook.com. If you would like to subscribe to my free weekly closed-end fund distribution change report, which now includes updates about the DiviX system and my new program, ETF Mastery, which is free to Closed-End Fund Mastery subscribers while it's in its development stage. Go to the Dividend Times product page and enter your email in the subscription box in the top right. Again, this is a free subscription. You are not obligating yourself, and emails are not sold. Thank you for watching.